Welcome to the Techno Fundamental Report for May 29th. Jesse Livermore, famous investor from the 1920s. Money is made by sitting, not trading. Now what he's referring to there is that if you're in a roaring bull market and stocks are in an uptrend and things are working, leave it alone. Don't overtrade because it'll really hurt your performance. However, if you're in a downtrending market and you're trying to use risk management techniques, such as stop losses and so forth, your trading is going to be higher because you're basically moving the portfolio into cash. Now, once you get into cash, then you got to worry about getting back in again, which is a hunt and peck process. So trading becomes necessary. But once you get that uptrend going, leave things alone. The stock market is never obvious. It is designed to fool most of the people most of the time. It fools a lot of people, including myself. Nikola Tesla, famous inventor, operated around the same time as Marconi, was very involved in wireless electricity, had numerous patents. However, he died broke. And the thing about these inventors is that they start these businesses based on their patents and their inventions, but very few of them make money. In fact, Tesla did not do well at all, and that means to me that sometimes he can be a great inventor, but you also have to be a great businessman. Scott Bessent says U.S. can grow our way out of national debt crisis by focusing on economy. What's important is that the economy grows faster than the debt. So you have a numerator, which is the GDP growth rate, and then you have the denominator, which is the growth rate of the debt. So what he's saying is that if we can sustain a 3% GDP growth rate, we can grow our way out of this. Now, he's saying that we could get to about a 3% GDP growth rate this time next year. Now, I really like Scott Bessent. I think he's one of the sharpest guys out there, and he's doing a great job. Okay, let's take a look at the market here real quick. Now, remember here, what we're looking for are things like follow-through days and moving above moving averages and getting golden crosses and so forth. What we're hoping is that this was the final low. But it does look like a major low. And what I mean by a major low is like the low in 2003. It would be like the low in 2009. Those were major lows. So we hopefully have a major low here. Now, we got our first follow-through day right in here around April 22nd. And we started doing a little nibbling. And you got to be very careful about not jumping in, like a cannonball in the pool. You want to move slowly. So then we got, into a nice little uptrend, started to trend up, holding that 21-day moving average. 21-day moving average is now moved above the 50-day, and actually it's moving above the 200-day. The index itself is holding quite nicely above the 200-day, and in fact, here yesterday, we actually got another follow-through day. So things are looking good here. Let's keep our fingers crossed. S&P, same thing, looks like major low here. We're starting to see that 50-day turn upward, and that 21-day is getting above the 200 days. So we're looking like an uptrend. The primary trend is up by our definition, which is the 200-day moving average. If you're above it, you think aggressively. If you're below it, you think defensively. And right now, we're coming out of a major low. This could be a new bull market. Hopefully, that's the case. Take another look at the NASDAQ here. This is the 25-day and the 50-day, and you can see we're getting that golden cross. This looks very healthy. The same thing for the S&P. We've got the golden cross. The moving averages are moving up. Now you can see here with the 50-day, we're starting to see an upturn here in the 50-day. So things look positive. The aggression index, remember now what we're doing is we're doing a ratio of the NASDAQ compared to consumer staple stocks. So aggressive versus defensive. So when the line is going up, it's saying that the market is risk on basically. It's not risk off. So you can see here that we've got the moving averages moving above and giving the golden cross here. So the aggression index is on a positive note. Interest rates are stabilizing. And now all I can tell you is what I see. And that looks like a stable environment for interest rate yields. Also, we use this indicator, which is basically the power index, and it's saying that, over the last 125 trading days, interest rates have dropped over 5%. So, if we can keep interest rates stable, and that would be a very good thing. Volatility index, we're seeing some improvement there. We're back below 21 on the VIX, which is just telling us that volatility is starting to normalize, and we're starting to get a little bit more of a normal market here. New lows on the New York Stock Exchange. We did have a little bit of an uptick here, but nothing major. Looks like to me the sellers have dried up here. There's just no more selling going on. We're also seeing a shift in sentiment here with the bull-bear ratio. The bulls are starting to outnumber the bears, and just barely. But it's, we had this really dramatic period. Now you can go back here in history, you can see, well, you get that dramatic period, but then it goes right back in again. Sentiment is a secondary indicator, but it is something to keep an eye on. Now last week I talked about the initial public offering market. The point I'm trying to make there is that you should watch these stocks because it's kind of telling you where the new leadership could be. Now this company is called CoreWeave. We talked about it last week. It's an IPO involved in artificial intelligence, mainly the infrastructure of data centers. You can see the stock came out in late March around 40 bucks. It's now up around 120-ish. So if you're keeping an eye on this as an investment, I would be very careful because this is a hot potato. Now we own the stock. I have to disclose that. Now we started buying this stock around the time of our first follow-through day, which was around this period right in here. So it's doing quite well. It's telling you that the IPO market is looking healthy, which is a real big positive. Now the way I would handle this is at this time would be I would want to see some consolidation in here. Now this thing may just keep zooming, but we're hoping it's going to consolidate, build a new base, and then break out again, and that's when I would take additional action. Now I just wanted to close with this. Look, if you believe in demographics as a driving force to the stock market, because you really can't ignore the fact that when the baby boomers, well, actually it all started in 1945 when everybody comes back from the war, starts having kids, we have a baby boom, and then the baby boomers come into their consumption years, which is age 35 right here in 1982. Oh, it was actually 81. Oldest baby boomer turns 35. So at 35, you start buying houses, you're buying cars, you're getting babies, and the whole deal. So when it's just interesting to me that in this period right here, which was the top of the market, the baby boomers basically turned 54. So that's the peak of their consumption years. Then we go into a major bear market. We come out of it. So in 2016, the millennials, the oldest millennial turned 35. So the millennials are in those consumption years, which we think is going to go to 2035 when the oldest millennial turns 54. So we got 10 years, and we need to make hay while the sun shines. So if you have any questions, please let me know. Thank you very much.